Okay guys, welcome to this lesson on Introduction to Reversal Patterns. A little bit of disclaimer first, okay? Make sure you read it properly before you move on. Basically, a little bit of recap, okay? Candlesticks can be classified into many different types, but one of the ways they can classify it is continuation patterns and also reversal patterns. So I'm just going to talk about reversal patterns now and then continuation patterns in another lesson. Basically, what are reversals? It just signifies that the markets are at an exhaustion point. So this means that if you have a bullish trend, the bullish trend may reverse into a bearish trend, and then if you have a bearish trend, it would reverse back to a bullish trend. Okay, so this is what I mean by reversal. But reversals can also mean temporary retracements. Okay, so in a bullish market, when price has been pushed up too much or too far, you would have a bearish reversal. So you see a bullish trend turning into a bearish trend. Then in a seller's market, when supply has been exhausted, you would see that the bearish trend would become a bullish trend. Hence, you would have a bullish reversal. A lot of technical traders make this mistake that they see a reversal pattern appearing at the wrong place, then they just assume that it is a continuation pattern. So try to not make this mistake. Same thing for continuation pattern. A lot of technical traders think that, okay, if the continuation pattern appears at the wrong place, then this means that it will become a reversal. Okay, if it appears at the wrong place, it just means that the movement will be random. Understand what I'm saying? So some of the principles of reversals you need to take note of. Reversals would actually mean that the market would temporarily correct itself, meaning there will be a temporary retracement. So for example, when you see a bullish trend, you will see temporary market corrections down a little bit and then goes up and then goes down, goes up, goes down. Understand what I'm saying? You'll see temporary retracements. So you need to understand that a temporary market correction is not as significant as a trend reversal, because when it comes to a trend reversal, a new trend is forming. And the other thing is that reversal signals, just like any other indicators, it won't work out all the time. So even if all the signs tell you that it is time to buy, the fundamentals, the technicals tell you that it is time to buy, the trade will still go wrong, because this is just part of trading. So that's why we don't predict the market. What we trade is in terms of probabilities. Okay, so I give you one example. Okay, so you see the same pattern over here. Okay, let's look at it specifically. You see a blue small candlestick followed by a large red candlestick. Okay, this is what we are focusing on. Small blue candlestick followed by large red bearish candlestick. Small blue candlestick followed by large red candlestick. Okay, if you cannot see, then zoom in a little bit for you. Okay, small blue candlestick followed by large red candlestick. Small blue candlestick followed by large red candlestick. So this is what we focus on. Okay, don't look at other candles. So then you realize that even though you have the same pattern, but because they form at different locations, then it behaves differently. This candlestick pattern is called bearish engulfing pattern. So it's supposed to signal a bearish move. But you see, when this bearish engulfing pattern appeared here, the markets only retraced a little bit before it went back up. Do you realize that? Whereas if the bearish engulfing pattern appeared here at the end of the trend, instead of retracing a little bit, the whole entire bullish trend ended, and then it went on a bearish trend. So how do you know a bearish trend has started? You see lower lows, okay, lower lows, as well as lower highs, okay, and lower lows. Understand what I'm saying? So the thing is, the appearance of a bearish signal or any signal, okay, it only tells you that the probability of a reversal has increased. It doesn't tell you that, okay, for sure the market would reverse. It only tells you that the probability of the market's turning has increased. So how do you know whether the market would reverse the downtrend or is it a temporary market correction? You would need confirmations. Okay, understand? This is what I'm going to teach you for the rest of this course. How to use confirmations to determine whether this is a temporary retracement or is this a permanent end of the trend. Now, how do you know whether a reversal is confirmed and that it is not like a temporary correction, market correction? One of the clues that reversal is going to take place is there's a divergence between price and the momentum indicator. Now, this, to put it in simply, it means that the price is moving in a different direction as compared to the momentum indicator. So, if the price are going up, momentum indicator is pointing downwards. If price is pointing downwards, going downwards, then momentum indicator, it is pointing upwards. So again, I'm going to give you more examples in the next few lessons, but this is just a little bit of glimpse of it. Okay, the second clue is a moving average crossover. I'll cover more on this during the moving average lessons. Okay, and then the third thing is there's a break of critical levels, for example a trend line or support resistance. And then number 4, there's a price action confirmation. So maybe in a downtrend you see a bullish reversal signal, and not only do you need to have a price action confirmation, you also need your momentum indicators to give you a signal, for example oversold or overbought signal. So if this confuses you a little bit, don't worry about that, it'll be covered in the next few lessons. Some of the reversal candlestick patterns you need to take note of is hanging man, hammer, bullish engulfing, bearish engulfing, evening star, morning star, doji, bullish army, bearish army. So when you see any of these patterns forming at the right place, okay, not just at any random place, when you see any of these patterns forming at the right place, at the right context, then you would either see two things: a temporary reversal, or you will see the end of the trend. But of course, sometimes, like I always said, things don't work out all the time, so it is possible to find one of these candles being formed at the right context and that it fulfills all the criteria. But then, instead of a reversal happening, the trend goes in the same direction, it continues to go in the same direction. Does this mean that the reversal pattern became a continuation pattern? No. It just means that the pattern failed. And this is just part of trading. That's it. Now the thing about these reversal patterns is that even though it tells you a reversal is coming, but it doesn't tell you how far will it go. Will it reverse by a couple of pips? Will it reverse by 500 points, 1000 points, 2000 points? It doesn't tell you that. That is why you need a lot more confirmation indicators. That's why you need to look at the context so that you can set your TP target properly. Now I just want to point out that one of these patterns, which is Harami pattern, okay, bullish and bearish Harami, they tend to delay in their reversal, meaning that they might appear right now, but then the reversal would only happen like few hours later, few days later, depending on the time frame that you're trading. So normally you see some form of delay when you see a Harami pattern because it is not as strong of a reversal pattern as compared to other patterns like engulfing patterns, the doji patterns. But when it still appears, you still need to take note of it because it is not so weak that it is insignificant. You know what I'm saying? So some of the principles of price reversals that you need to take note of. Number 1, I mentioned this already, but I'm just going to mention it one more time, and that is reversal patterns work best when found near or at the end of the trend. Ideally, you want to find it right at the end of the trend, right here. Of course, on hindsight, you cannot tell, is the trend ending here? Is the trend ending here, here, or here? But if you apply what I teach you just now, the divergence and then the break of critical levels, all those are confirmations that tell you that this is a reversal of the trend. Understand what I'm saying? But of course, there are more ways that you can determine, okay, this is the end of the trend, which is what I'm going to teach you in the next few lessons. The thing is, if reversal patterns show up in a ranging market, okay, it is not going to reverse that much, okay? And if a reversal pattern shows up in a very volatile choppy market, it is also not going to work out. Ideally, you want it to show up in a nicely trending market at the end of the trend. Why is that? Because reversal patterns need something to reverse. If there's no trend to begin with, then there's nothing to reverse from. Okay, so number 2, reversal often occurs after sharp rally or sell-off. Now this is one of the clues that you are trading at the end of the trend, because normally at the end of the trend you will see a very sharp spike in price upwards or a sharp sell-off, meaning that you see a big large bearish candle. So for example, this is a big candle over here at the end of the uptrend. So normally, not all the time, normally when you see a big spike like this, traders would want to take profit because of many reasons, one of which is, okay, the markets right now are so high. I don't think it's not going to go any higher, so people start taking profits. And then when people start taking profits, those who are still in a buy trade, they'll panic and then they'll get stopped out, and then the selling goes on and on and on. Basically, the more buyers that came in during this sharp spike over here, the more traders would want to take profit, okay? And hence the higher chance that the trend is going to end. So this one of clues that tell you that you are trading at the end of the trend. And so this one is an example of a bearish trend. You see again the same thing. This is a bearish trend over here. Just by looking at the candlestick alone, ignore the moving average for now. You see a sharp sell-off. Now this also happened in the stock market. You see a sharp drop, a sharp sell-off, 90-degree drop, just like this one. This tells you that high chance, not guaranteed, but high chance, the market has already reached its bottom and it's going to U-turn and reverse. Understand what I'm saying? So this sharp sell-off is then confirmed by 2 bullish candlestick signals over here. Okay, if you know how to read candlesticks, which I'm going to teach you next time. Alright, so this is one of the confirmations. Then of course, the crossover happens later on. This is another confirmation that, okay, the trend has ended. Okay, so number 3, you need to learn how to spot false reversals. Now, like I said just now, the reversal pattern has to occur at the end of the trend. So if it occurs right at the beginning of the trend and you see the reversal pattern form, then that might be a sign of a false signal. Okay, so when it comes to looking for entry signals, you also need to learn how to spot the false signals so that you can reduce your losses. And then number 4, you can use reversal signals for 2 purposes. Number 1, use it to exit your trade completely, or you can use it to scale out. So back to this example again, if you see a big sell-off at the end of the trend, and also when you see the price go above, okay, go above this candle high, then there's a signal that the trend might potentially end. Of course, not immediately. It might just be one of the clues that the whole entire trend would go on a bullish trend soon. Okay, so another way that you can exit is you can use it to scale out. So when you see a bullish reversal signal at the end of the downtrend after a sell-off like this, then you can use this as an opportunity to scale out. If you're more of an aggressive trader, then you can scale out, but if you're more conservative, you can just get out completely. And then number 5, you can also use reversal signals to enter into an opposite trade. If you are somebody who is more of an aggressive trader, then you can use this to pick tops and bottoms. But like I said just now, don't just use candlesticks to pick tops and bottoms. You need a confirmation that the trend has ended, that a reversal is going to take place, that this is not just any temporary market correction. So only once you become more experienced, then you can pick tops and bottoms and enter into an opposite trade. So a safe way for you to enter along with the trend is when you see a bearish reversal signal in a downtrend. Okay, so once the price retraces a little bit, which happens, retraces up a little bit, and you see this bearish reversal signal over here, plus it forms at the critical level, which means that it forms at the test of this moving average over here, then you can make a sell. So I'll elaborate more on this in the next few lessons. Okay, and then number 6, just now I mentioned that the reversal pattern is best found at the end of the trend, and there are some trends that takes a few days to form. There are some trends that takes longer, like a few weeks or a few months to form. So you want it to be found at the end of a long-term trend. A good trend is not a trend that is formed within a few seconds, within a few minutes. That is not considered a trend. That's not considered a strong trend. So one thing you need to take note of is that the reversal pattern will be stronger, will be higher probability if it forms at the end of a long-term trend. Meaning the trend has been going on for a couple of weeks, couple of days, rather than a couple of seconds or a couple of hours, like only a few candlesticks. If it forms at the end of a short-term trend, then it wouldn't be as strong as compared to if you see it at the end of a long-term trend. When you see a reversal pattern after a small decline like this, a small retracement like this, it wouldn't be as strong as compared to if you see a larger reversal like this one. So if you have to compare this retracement with this retracement, if a reversal pattern forms here, it will be weaker as compared to if the reversal pattern forms here. You don't want to get into a retracement trade when the retracement is only a few candles like this one. Okay, this one wouldn't be as strong. Like this one wouldn't be as strong because it's only a small retracement. What you want is a very obvious retracement like this one. Understand what I'm saying? So this is one of the things that you need to take note of when it comes to context. Is the retracement big enough for you to get in, or is the retracement not that significant? Is the trend long enough for you to get in, or is the trend not significant enough for you to get in? Okay, with that, I hope that this lesson gives you a good picture of reversal pattern, the concepts of reversal patterns.